model uncertainty. Regime switches here mean the change in the economic regimes, and model uncertainty here we refer to the ambiguity about the probability loss of the transition intensity of the economic regimes. So basically, we are going to consider a model which can capture three features: transition causes, regime switches, and model uncertainty. So let me first give a very simple example of a regime switching model. Let's say we consider a two-stage regime switching model in discrete term for a return process yt, and return process actually can take two regimes depending on the state of an underlying Markov string. Let's say the underlying Markov string has two states, state 1 and state 2, right? Xt equal to 1 mean the economic state at time t is a good state. Xt equal to 2 mean the economic state at time t is in a bad state. So when the economic state is good, then yt take the first dynamics with the mean with the expected return mu1 and the volatility sigma 1. So this is the risk return pair in the good economy. And when xt equal to 2, say when the economy is bad, then yt take the second regime with the expected return mu2 and volatility sigma 2. So this mu2 and sigma 2 is the risk return pair in the bad economy. So you can see that the dynamic for the return process can change over time according to the stage of an underlying economy described by the Markov string xt. And here, some historical remarks on regime switching models. Actually, the idea of regime switching model maybe date back to the work by Kuen in his or her paper published in 1958 in Journal of the American Statistical Society. And in the paper, a regime switching regression model was considered. Then later on, a paper by Goldflat and Kuen published in Journal of Econometrics in 1973. They also consider a regime switching regression model. And it seems that this is the first paper published in Journal of Econometrics, if I'm not mistaken. The probability, the idea of probability switchings I would say that the application of the idea of probability switching to nonlinear time series was proposed by Tong. And you can look at his two classic monographs on nonlinear time series analysis published in 1983 and 1990. Hamilton proposed a Markov regime switching autoregressive model to economics and econometrics in his article published in Econometrica in 1989. In fact, option valuation under regime switching model have been considered by many authors. Many people have made important contributions to these fields. And here, give some early work in this field. And actually, some important issues have been addressed in the literature. For example, selection of pricing kernel. The market described by regime switching model is incomplete. In this case, we have more than one pricing kernels or equivalent martingale measures. So a key question is, how can we select a pricing kernel, okay, for valuing assets or options or contingent claims in this market? And this question has been addressed by various authors using different approaches, such as Escher transform or other approaches, minimum entropy martingale measures, etc. And one related issue is whether the regime switching risk should be priced or not. And this issue has been considered by some author as well. Depending on different objective criteria they used, some literature proposed that regime switching risk should be priced, And some other literature propose that regime switching risk should not be priced. And the situation that the underlying economic regimes are hidden has also been considered in the option valuation literature. Both the discrete and continuous time situation have been considered. The basic idea is to integrate stochastic filtering and option pricing. Regime switching models have been used in actuarial science for pricing modern insurance products such as equity-linked securities, participating life insurance products, etc. And here are some examples of the work along this direction. However, many existing work seems to focus on the economy without transaction costs. However, transaction costs is a reality in the economy. In fact, transaction costs play an important role in economic sciences. According to some economists, such as Ronald Coase, transaction costs can be defined as the cost of carrying out market transactions, such as the cost involved in buying or selling in financial markets. Okay, in particular, this is the interpretation in the financial market. As I mentioned before, transaction costs play a significant role in economic sciences. In fact, in the classic article by Ronald Coase published in 1937, this is a Nobel Prize winning paper. This is one of the Nobel Prize winning paper of Ronald Coase, and he got Nobel Prize in 1990s. It took a long time for the work to be recognized. Close to 60 years. And he applied, transaction cost to explain the existence of firms. In particular, he argued that the existence of the firm may be due to the reduction of transaction costs. Williamson and other economists, he got the Nobel Prize because in economics science because of his work in transaction cost economics. In fact, transaction costs play an important role in industrial organization, which is a field in microeconomics. And transaction cost approach is one of the major approach in industrial organization to explain the different organizations of firms from different industries. Actually, you may ask what happens if transaction costs are absent in an economy. Actually, some interesting or strange thing can happen. For example, according to George Stigler, the absence of transaction costs in an economy like the absence of fictions in a physical world. And there would be no economic foundation for the existence of firms as well. And here, option valuation and with transaction costs, this is a challenging problem, and this problem has been attempted by many scholars. And here are just some example. It seems that from the mathematical or economic point of view, one of the important contributions was to divide sublinear pricing rules due to the presence of transaction costs. However, it seems that many existing models only focused on the homogeneous market situations. Although there are some work on option on optimal asset allocation in the presence of transaction costs and regime switches, it seems that not much work has been focused on incorporating economic regimes in option valuation in the presence of transaction costs. And what we are going to do, before I talk about the key points of this work, I just also want to introduce another things, option valuation with model uncertainty. Actually, this problem has been addressed from different angles. For example, an empirical model has been proposed to for option valuation and volume implications in the presence of model uncertainty and homogeneities in the market. and their work on the use of some risk measures, such as coherent risk measures and convex risk measure for derivative pricing in the presence of model uncertainty and its implication for model risk management. The large deviation approach has been introduced to select a pricing kernel for non-redundant derivative security, which is robust to model misspecification. In the paper by Boyle, published in Review of, and other published in Review of Financial Study. And there's a recent paper published in Econometrica, if I remember correctly, which established a general nonlinear equilibrium with sublinear prices in the presence of model uncertainty about state prices. In this paper, they also investigate the relationship between sublinear price generated by model uncertainty and sublinear prices generated in the presence of transaction costs. So what we are going to do here, here are some key points. Okay, first, we are going to develop an option valuation framework, which aims to incorporate three features: transaction costs, regime switches, and model uncertainty. And we are going to derive sublinear pricing rules for bid-ask prices of European options using, stochastic optimal control theory. Basically, we are going to consider solution of a kind of band-band type stochastic optimal control problems. And we are going to derive or determine a fair price of a European option by minimizing a relative, by solving a relative entropy minimization problem. And we can obtain a closed form solution to the relative entropy minimization problem. And we are going to introduce an efficient numerical scheme based on finite difference method to implement the model. In particular, we are going to develop a numerical scheme based on finite differences for approximating the asked, the fair, and the bid prices. And we are going to conduct numerical investigation for illustrating the relative significance of the impact of transaction costs and regime switches on the asked, bid, and fair prices. So now we are going to talk about the model. We consider a continuous time security market with two basic security, a bond and a share. And this security are supposed to be continuous, supposed to be tradable continuously over time. And we are going to model the changes in economic regimes by a continuous time finite state market chain with the state space called the canonical state space, which consists of n elements, xe1, e2 up to en. E1 actually is a unit vector with 1 in the first position and 0 elsewhere. And E2 is a unit vector, which actually, with the 1 in the second position and 0 elsewhere. And En is a unit vector with 1 in the n position and 0 elsewhere. And these n unit vectors actually represent n different economic states. And to describe the probability law of this Markov chain, we are going to use the weight matrix, A, and here Aij represent the transition intensity from the state Ei to the state Ej. And here, there's a semi-martingale representation of the Markov chain, which gives a dynamics for the Markov chain. You can see here, MT is the martingale terms, and this is the term, this is the predictable term of finite variation. In fact, this, is a special semi-martingale. And now, we assume that the market parameters, let's say the interest rate at time t RT, the expected return mu t at time t, and the volatility sigma t at time t can switch over time according to the state of the economy at time t described by the value of the Markov chain xt at time t. So here, I mean, this bracket mean a scalar products. So I mean, R here represent a vector of interest rate corresponding to the n economic state. And so I mean, if xt is in the state ei, say if the state of the economy is in the I state at time t, then this interproduct will extract the I component from this vector R. So RT is actually equal to Ri if the state of the economy is in at time t is in the I state. And similarly, if the state of the economy is in the I state, then mu t is equal to mu I, and sigma t is equal to sigma I. And now, I mean, the bond price process and the share price process under the real-world probability P are governed by these two dynamics. This is the bond price dynamics. Okay, this is the share price dynamics. In particular, the share price dynamics is governed by a Markov regime switching geometric binary motion where the drift mu t and the volatility sigma t depends on the state of the economy at time t modeled by xt. Now we consider transaction costs, and we consider the general situation that transaction costs can depend on the economic state. So in other words, transaction costs are regime switching. For simplicity, we assume that only trading in the underlying share incurs transaction costs. And point T here represents the amount of money invested in the share at time T, right? And F here, Ft represents the proportional transaction cost for a long position if pi t is greater than 0, or a short position if pi t is less than 0 of the share at time t. So when pi t is less than 0, so we are considering a short position, then the proportional transaction cost must be negative. And here, if pi t, okay, is, let's say if we now short the amount of $100 in a share, okay, in this case, suppose that the proportional transaction cost is minus 5%, then the transaction cost for the short position is $5. You can see that the multiplication of pi and f is a positive number, right? And here we allow the general situation that the transaction costs can depend on the economic regime described by xt. So here, f is a vector which contains different proportional transaction costs in the n economic regimes. Let's say f1 represents the proportional transaction cost in the first economic state, and f2 is the proportional transaction cost in the second economic state, and fn is the proportional transaction cost corresponding to the n economic state. And now, we suppose that lambda k actually, I equal to 1 and 2. So we have lambda 1 and lambda 2 here, and each of them can depends on the economic regime xt. And in fact, later on, when you see some of the assumption here, you will see that actually, minus lambda 1 is the lower bound of the proportional transaction cost, and lambda 2 is the upper bound of the proportional transaction cost at time t. And here, the first condition we have seen before, we want the product of pi and the proportional transaction cost f to be non-negative. As illustrated here, okay, the product of these two must be positive. And the last condition here is the condition to guarantee no arbitrage opportunities. So here, you may ask, what are the economic justification for the situation that the transaction costs are regime switching? In fact, the variation of transaction costs may be due to large liquidity stocks. Which may happen when, which may happen when, during the period of the the market crash in 1987, the collapse of LTCM or the global financial crisis, etc. And now, I mean, the world process corresponding to the portfolio process pi and the proportional transaction cost F is given as here, right? Then what we are going to do next for option valuation is to specify a family of pricing kernels which can price both the price risk and the regime switching risk. And here, price risk is described by the standard binary motion WT, and price risk is due to the fluctuation in the share price. And regime switching risk is modeled by the Markov chain. And regime switching risk, as I mentioned before, is attributed to the transitions in economic regimes. And here we are going to use, we are going to use a Python kernel, which is based on a measure change for the binary motion WT and a measure change for the Markov chain XT. And some related Python kernel has been considered in the literature, such as here. And for describing the information structure in the model, we consider an enlarged filtration. This means that at time t, we can access to the information of the share price up to time t, and the information about the economic state up to time t. And now we define the market price of risk. Okay, I mean, this is to compensate the price risk described by the binary motion WT. And this is the market price of risk, which from here we can see that is regime dependent. And now, I mean, we consider, I mean, this exponential martingale, and this is obviously a density process for the measure change for the binary motion using Giessen theorem for standard binary motion. And now we have the measure change for the Markov chain XT, okay? And to define the density process for the measure change for the Markov chain, we consider, you know, Kij, which is the counting, which is the jump counting process of the Markov chain. For example, Kijt represent the number of jumps from state Ei to state Ej in the interval from 0 to time t. And now we consider this martingale here, which is called the fundamental martingale, okay, for the jump process, right? And here, I mean, this is basically the compensator of the jump counting process, Kij. And you can see that the compensator depends on the transition intensity, Aij. And here we can define lambda eta, okay, which is the exponential martingale here. Okay, this is actually the density process for the measure change for the Markov chain. For those who are familiar with the density process for measure change for Poisson jump process, you can see that this density process is closely linked with the density process for the measure change of Poisson jump processes. And in practice, it is difficult to specify the probability laws, in particular transition intensities of the economic regimes. So to incorporate model uncertainty or ambiguity about the probability law of the economic regimes, we consider a family of candidate models. And this family of candidate model is introduced by p-dubbing the transition rate Aij along the direction eta ijt. And here we assume that to incorporate ambiguity, we assume that eta ij actually take value in the range with in the interval here with the lower bound k minus and the upper bound k plus. And k minus here, I mean, it assume, you know, to take the value in this interval, right? And here, you know, you may ask, how can we actually determine the lower and upper limit? Okay, k minus and k plus. We are going to apply the asymptotic theory of maximum likelihood estimate of transition probability of Markov chain in the paper by Anderson and Goodman, published in 1957 in Annals of Mathematical Statistics, which seems to be a precursor of Annals of Statistics. So the idea here is that we are going to consider a discretized version of the underlying Markov chain. Then we will have a sequence of observation of the Markov chain, which is given by time series observation of the so-called quantized state of some economic factors such as GDP or consumer price index (CPI). So I mean, the idea is that we are going to turn these numerical economic factors into categorical factors through the process called quantization. So in this case, based on this time series observation of the quantized state, we can calculate the maximum likelihood estimate of the transition probability Pij of the train from state Ei to Ej. Then, I mean, using the asymptotic theory for the maximum likelihood estimate, we can approximate the lower and the upper limit k minus and k plus as here, and set alpha to divide by 2 here. This is actually the critical value of a standard normal distribution. And here, to ensure that, I mean, k minus satisfy the technical condition that, I mean, this lower bound is greater than, strictly greater than -1, then we impose the condition here where epsilon 0 is a small positive number. And now, I mean, we consider, we introduce a probability measure Q theta eta, which is equivalent to the real world probability P in the sigma algebra GT, which is the terminal sigma algebra of the filtration GT. And so this probability measures is introduced by a product of the terminal value of these two density processes for measure change, lambda theta. This is the density process for the measure change of the binary motion. And this is actually the density lambda eta. This is the density process for a measure change of the Markov chain. So by Gersanov theorem for binary motion, the process W theta here, defined by the translation of the original binary motion along the direction of theta. This W theta is a standard binary motion. And also, according to a Gersanov theorem for the Markov chain, under the new probability measure, the weight matrix xt of the Markov chain xt at time t is given by a eta t here, and the component aij eta t here is given as here. This is actually the transition intensity of the Markov chain xt under the new probability measure from the state Ei to the state Ej at time t. And this new transition intensity is given by the original transition intensity Aij multiplied by a factor here. And this is the directions, I mean, of the perturbation of the original transition rate. Of course, in order to make this, I mean, to be the transition rate, we require this to be non-negative for I not equal to j. When I equal to j, of course, this is non-positive. Now, under the new probability measure, the share pi process is given as here, and the well process is given as here. And it is not difficult to see that the discounted share pi process is actually a local martingale, right? And actually, I mean, under some condition to be introduced later, I mean, condition 3 here, actually, I mean, this well process is bounded below by negative random variables. Then, I mean, it can be so that the well process actually is a super martingale under Q theta eta, right? In fact, there's more than one probability measure Q theta eta under which the discount share pi process is a local martingale. So in this case, the market is in fact incomplete. So I mean, now we consider the well process, I mean, as a function of the initial state set at x. So the initial state at time t are set at x, right? And now, I mean, we can define the concept of admissible portfolio processes. Okay, this is the set of admissible portfolio processes if, I mean, the portfolio process satisfy these three conditions, right? Four conditions, sorry. The first condition, I mean, basically say that, I mean, this is predictable with respect to the enlarged filtrations. As I mentioned before, this condition is required to prove that, I mean, this is the well process is a super martingale. And also we require the well process, I mean, the stochastic differential equation governing the well process has a unique strong solution. Now we consider a European option would pay off at maturity t, which is equal to the function h of the terminal share pair st. Now we are going to define the two endpoints of the arbitrage-free price interval of the European options. And this is the lower bound of the price interval, and this is the upper bound. The lower bound actually here can be interpreted as the maximum price a buyer is willing to pay to buy the option. We can see this from here. This is the maximum price at which we can find a portfolio. I mean, in fact, the buyer of the option can find an admissible portfolio point such that the terminal wealth of the buyer plus the proceed the buyer can receive by exercising the European option is non-negative. So basically, this is the maximum price a buyer is willing to pay. And this is also interpreted as the bid price of the option. On the other hand, the upper bound is given as here, which is the minimum price a seller is willing to accept, okay, for selling the option. In fact, we can see from here, this is the minimum price at which the seller can find an admissible portfolio such that, you know, here the terminal wealth of the seller minus the amount the seller need to pay for if the buyer of the option exercise the option at the terminal time is non-negative. So this upper bound is in fact the minimum price a seller is willing to accept. This is also interpreted as the ask price of the option. Now we are going to determine the bid price VB and the ask price VA by following the three steps here. The first step, okay, we formulate two stochastic optimal control problems. Second step, we relate the values of the optimal control problems to the classical solution of two systems of coupled nonlinear partial differential equations. Lastly, we are going to characterize the bid and ask prices at the classical solution of the system of the two systems of the coupled nonlinear PDE by linking the bid and ask prices with the values of the control problems. And now, I mean, you know, here we have the definition. The first definition is to define the set of admissible transaction courses. We require that the transaction course take the value in the interval from minus lambda 2 to lambda 1. And the second definition here actually try to define the set of admissible perturbation for the transition weight, Aij. And we require that, you know, here eta t is in this interval. We specified before to incorporate ambiguity in the transition intensity of the underlying Markov chain. We also need this measurability condition in the time t. This is a technical conditions. And now, I mean, the space, I mean, of the of admissible transition courses at admissible perturbation for transition intensity is given by the product space here. And now, we can define a new probability measure, Q lambda eta, which is equivalent to the probability measure Q theta eta, okay, by the density process here for the measure change. And we can interpret this Q lambda eta to be an auxiliary market pricing measures. Okay. Okay, now we consider these two stochastic optimal control problem. FA, the first one is a maximization problem, have a value function FA. This is basically we try to choose lambda and eta such that the conditional expectation of this discounted payoff of the option is maximized, right? And now, we have the second optimal control problem with the value function FB. And here, this is a minimization problem. We are trying to minimize the expected discount payoff of the options by choosing lambda and eta. And we can interpret the value function FA as a sublinear expectation and the function FB as a superlinear expectation. And now we consider two systems of coupled nonlinear partial differential equations. This is the first system. This, you will later on see that we'll relate this to the ask price over different economic states. And we'll relate this, system of nonlinear PDE to the bid prices of the options over different economic states. And you can see that actually, these two equations, these two systems of nonlinear PDEs are generalization of the Black-Scholes-Merton option pricing PDE, in the sense that the presence of the term here and the term here is due to the regime switching effect, and the presence of this term here and this term here is due to the ambiguity in the transition intensity of the economic regimes, and the presence of these two terms here is due to the presence of transition causes. So if we don't have transition cause, we don't have ambiguity, we don't have regime switching, all these terms disappear. So we will get back to the original Black-Scholes-Merton option pricing PDE. And now, the first theorem here say that the value function of the two stochastic optimal control problem, actually the two stochastic optimal control problem are of band type. And they can be represented by the classical solution of the system of the coupled nonlinear PDE given as here. This is the main result of the first theorem. And the second theorem say that if these three conditions hold, then the bid price in the I economic state is equal to the I solution of the second system of nonlinear PDE. And if these three conditions hold, then the ask price in the I economic regime is equal to the I component of this, of the first system of coupled nonlinear PDE. And now, we can see here from the economic point of view, what we have derived here actually provide a perspective to explain the bid-ask prices for European option due to three factors: transaction costs, regime switching, and also ambiguity. Of course, there are other approaches to model or explain bid-ask spreads or bid-ask prices. For example, we have the approach by Dini-Medan, and his co-author. And this approach actually is called the two-price conic financial approach. The idea is to introduce a market cone based on the concept, introduced in the in coherent risk measure called the set of acceptable risk. From this set of acceptable risk or market cone, the bid and ask prices can be generated. And there's another approach called the market microstructure theory. This try to explain the bid-ask spread by different factors like the asymmetry in information and the inventory causes. Okay, now we are going to discuss how can we determine a fair value of the European options within the pricing interval. And now we are going to determine a fair value by minimizing the relative entropy. In particular, we are going to minimize the relative entropy between the physical measures P and the auxiliary market pricing measure Q lambda eta, right? And so this is the one, okay? And the idea is that, this is actually the relative entropy. The idea is that we are trying to choose lambda and eta such that this relative entropy is minimized. And lambda Decker and eta Decker is an optimal pair. So it can be so that the minimization problem we have seen here can be decomposed into two problems here. The first problem is to choose lambda to minimize these quadratic terms. And the second problem is to choose eta to minimize this expectation. The solution, we can obtain closed form solution to problem 1 and problem 2. To problem 1, we have this kind of threshold type solution where if the negative of the market price or width fall into this interval, then lambda Decker is equal to minus lambda 2. If minus theta fall into this interval, then lambda eta equal to minus theta. If minus theta, the negative market price or risk, fall into this interval, then lambda Decker equal to lambda 1. And here, this is the solution to problem 2. Here we see that actually eta ij equal to 0. This corresponds to the situation that the regime switching width is not priced. And this corresponds, this is related to the situation, in the paper I published in 2011. And also, the situation where regime switching width is not priced is consistent with the priced or the pricing measure selected by the Escher transform. Of course, the use of the Escher transform to option pricing was introduced in the classic seminal paper by Kuen Siu in 1994, and in the paper by Robert Elliott, Lennon Chen, and myself, published in 2005, we apply Escher transform to price option under regime switching model. And here, we have the fair value, of the European options. You can see that, this actually, is given by the expected discounted payoff. This is basically this neutral valuation, and this is the pricing PDE. Okay, we have a kind of a regime switching, we have a system of PDE correspond to the regime switching situation. And also we have the parameter here, lambda Decker, which incorporate the pattern of transaction courses. And now we are going to talk about numerical implementation. We are going to use finite difference scheme, okay, and we extend the standard finite difference scheme to incorporate transaction courses and regime switches. For simplicity, we only consider two-state situation, and in this case, in fact, we have a two-layer, two-dimensional grid, and each layer represents one regime. And for each grid point ik, okay, we can have this tk to be the time point, and si to be the price point, and delta t, delta s, they are the time step and the price step of each grid. Then, of course, we are going to use the finite difference scheme to approximate the ask price, the bid price, and the fair price. And here we just use the ask price in the two regimes as illustration. So this is the fair price in the first regime. This is the ask price in the first regime, and this is the ask price in the second regime, correspond to the time point tk and the price point si. And here by some calculation, we can actually determine this set of coefficient in corresponding to the first regime, and this set of coefficient corresponding to the second regime. Then we have this, pair of coupled backward deterministic difference equation to approximate the ask price. We can calculate this, recursively, backwardly over time for the ask price in the first economic state and for the ask price in the second economic state. And now, we are going to talk about the numerical result for the ask price, fair price, and the bid price. and the numerical result will compute using R. And here, we consider, the European call option, okay, with strike price 100 and maturity 1 year maximum, okay. So, the hypothetical value, which I expect in terms of per annum of the model parameters are given as here. In particular, R1 and R2, they are taken, from the cash rate of the Australian Reserve Bank of Australia. The cash rates are over this 2 different periods, and they correspond. Of course, they correspond to 2 different regimes. Regime 1, which is the good economy. Regime 2, bad economy. And now the hypothetical value for the transition rate of the underlying Markov chain describing transition in economic state are A12, which is 0.2. This corresponds to the situation that the expected duration in a good economic regime is 5 years, and A21 is 0.3. This corresponds to the situation that the expected duration in the bad regime is approximately 3.3 years. And now these are the hypothetical value for the upper and the lower bound of the transition rate, all right? And in particular, you can see that we allow this, the lower bound to be negative to incorporate the situation that, the low regime switching, the situation of price of not pricing regime switching risk is incorporated in the scenario. So here, the hypothetical value for the model parameters in a 2-dimensional grid is specified here. These are the hypothetical value for the upper and lower bounds of the transition cost in the good and the bad economy. Now we are going to consider the numerical result. Okay, I enlarge the graph. Actually, we focus on panel A. Okay, first because the result in panel B, panel C, and panel D actually agree with the result from panel A. And from panel A, we can see, okay, first we consider the situation that the starting regime is in state 1. And here we plot the call price against the stop price. And here with the one at the end here, this corresponds to the price, okay, let's say MFRS 1, this corresponds to the price under the model which can incorporate both transaction costs and regime switching, where the economic state start from state 1, and MF1 here, the green curve, actually correspond to the situation that only transaction cost is incorporated and the starting economic state is 1. And RS here, the red curve here, this correspond to the situation that we only have regime switching and the starting economic state is in state 1. So we can see that by comparing, the back curve and the green curve, you see they are very close to each other. On the other hand, by comparing, the back curve with the red curve here, you can see that they are very far away from each other. This means that the impact of the market frictional cost or transaction costs on the core price is more significant than, the impact of the regime switching effect, all right? So, by considering the blue curve here, this corresponds to the model with both transaction costs and regime switching, and the starting economic state is 2. And considering, the yellow curve here, MF2, this actually corresponds to the situation that only transaction cost is incorporated, and the starting economic regime is 2. And also, the last curve here, the brown curve, where we only have the regime switching effect, and the starting economic state is 2. So you can see that, comparing, for example, the blue curve and the yellow curve, they are very close to each other. However, when we compare the blue curve with the brown curve, they are very far away from each other. Again, starting from the bad economic state, the effect of the transaction costs or the market frictional costs on the core prices is more significant than the effect of regime switching, right? And now, okay, we look at another figure. Again, we focus on panel A because panel B, panel C, and panel D, they correspond to, similar situation. They just, correspond to all of the money option. The money option at the in the money option, and those called are ask fair and bid prices are put against time. But here the ask fair and bid prices are put against stop price. But as I mentioned before, we can focus on panel A because these three panels basically give similar conclusion. And here, we can have, the first curve here. We focus on the starting state to be the good economy, state 1. So we look at the back curve here. Okay, this corresponds to this is the ask price given by the model with both transaction costs and regime switching. And the green curve here. Okay, this is the fair price computed by the model with both transaction costs and regime switching. And we have the bid price here. Okay, this is the bid price computed by the model with both transaction costs and regime switching. You can see that actually, of course, the fair price, the green curve, lie between the ask price, the back curve, and the bid price, the red curve, right? However, you can see that the fair price and the ask price are very close to each other, but okay, the bid price is far away from both of them. So this is one of the features we can identify here. Similar feature can be identified when we look at the ask price. When the economic state start in the best state, right? Let's say when we look at the blue curve, when we look at the yellow curve, and when we look at the brown curve, you can see that the blue curve and the yellow curve are very close to each other. However, the brown curve is here, which is very far away from these two. All right. Again, we have the conclusion that the fair price and the ask price are close to each other, but the bid price is far away from both of them. We can, panel B, panel C, and panel D give similar situation. Now we look at the last pair of the graph in this presentation. So again, we can consider panel A. Panel B also gives similar conclusion. Panel A actually consider situation state 1, the starting economic state 1, and panel B consider the economic state, the starting economic state 2. From here, we can see that actually, of course, we look at the ask price first. Okay, this is the model. This is the ask price computed by the model with both transaction costs and regime switching. And this is the ask price compute. From the model with market with only transaction costs. And this is the ask price. The red one is the ask price computed by model with regime switching only, right? You can see that by comparing the back curve, the green curve, and the red curve, we can see that the back curve and the green curve are very close to each other. However, the red curve is somewhere here, okay, which is far away from both of them. Okay, so this means that actually the market frictional cost or transaction cost has a more profound impact on the ask price than the regime switching effect. And similarly, when we look at the bid price, we can see similar situation. Let's say we compare the blue curve, right, and the yellow curve and the brown curve here. You can see that the blue curve and the yellow curve are very close to each other, but the brown curve is more far away from both of them. So this again actually illustrates that the regime, the market transaction, the market frictional cost or transaction cost has a more significant impact on the bid price than the regime switching effect. So the conclusion and the summary of the study is here. Okay, let me make it smaller first. Okay. So the impact of the market transaction cost or market fictional costs and or transaction costs on the fair price seems to be more prolonged than the impact of regime switches. This indicates that the economic consequences for option pricing of transaction costs may be more significant than regime switches. And this may be the case at least for short life or medium-term options. The fair prices are closer to the corresponding ask price than the corresponding bid prices. This may indicate that the fair values, selected by minimizing relative entropy, are conservative. Lastly, market fictional costs or transaction costs have a more significant impact on the ask and bid prices for the European call option than regime switches. So this is the end of my talk. Thank you very much. Here is the list of the references. Right, thank you.
Okay, thank you very much. It was a very nice talk.
Thank you.
Yeah. So I just raised hand to show other participants that if you have any question, you raise your hand. Okay. Yeah. Okay. So yeah. I have a question. Okay. I was trying to have an intuitive understanding of the price difference due to the transaction cost. And then I got stuck in one place because I was thinking that if I am a writer of the option and if I have to pay transaction cost, then I would rather charge a little more for the price of the option. Contrary to the case that where there is no transaction cost. If I compare with two different scenarios, then without transaction cost, whatever the fair price I would charge to the buyer, I would possibly charge a little higher if there is a transaction cost.
Yeah.
That's sort of intuition I am getting. Maybe I am wrong. However, from the plot, it shows that with transaction cost, the curve of option prices are lower.
Hey, which one?
The rate curves, or
the record. You mean now you talk about the fair price, the ask price of the bid price. Now, if you talk about the fair the fair price, then I show you this plot. Right?
Okay.
Yeah. So let me enlarge it again. So you mean the red one?
Yeah, I'm trying to understand that the comparison between option price with transaction cost and without transaction cost.
Now, let's say if we actually look at the back one and the red one here, okay, the back one is somewhere here, okay.
Correct.
The red one is here. So with the transaction cost here, the black curve is here, the red curve is here.
Oh, so, black curve is for transaction cost.
Yeah, you see here?
Okay.
This is the black curve. And this is the red curve.
So red curve is not for transaction. Okay, no transaction.
No transaction, because RS here we only have regime switching, but without transaction cost. And the black curve here is actually the one with both transaction cost and regime switch. MF here mean market fiction. Market fiction mean transaction cost, and RS is regime switch, right? Okay. So the black curve is above the red curve.
Sure.
Yeah, and also this also holds for when we look at the ask price, also the same. Let look at the back curve. It is obviously about the no, not this one. Sorry, I just go to the figure here. Yeah, okay, panel A. Okay, we look at the back curve. Okay, the back curve. Yeah, it's a because the plot is a little bit not very nice. I plot it using R, right? But I plot it using some symbol tool in R actually. And here, this is the back curve, all right? And this is the red curve, all right?
Okay.
So the red curve is below the back curve. This is also for this is true for the ask price as well. Yeah. Yes,
Okay,
correct.
thank you very much. Yeah.
Yeah, no problem. Yeah, you're welcome. And thank you very much for your question. It's a very good question. Thank you.
Okay. Okay. Is there any other question from the audience? Okay, if there is no more question, I would thank the speaker again. Thank you very much for participating and accepting our invitation.
Oh,
It
thank you
was
very
a
much.
it was a very interesting talk where I learned a lot about this topic with transaction cost. Okay.
Oh, thank you very much for giving me the opportunity to present here. Thank you. So
Okay,
maybe
so
I stop sharing. I stop
yeah,
sharing.
you may stop sharing. Yes.
Yeah.
So
Yeah.
now we take.
It's okay now. Already stopped. Yeah.
Yes, it
Yeah.
is stopped.
Okay. So thanks.
Yeah. Now we take 5 minutes break, and and we come back within 5 minutes for the next stop. Okay. Yeah.
So my talk is about inhomogeneous affine Volterra processes and rough features in financial markets. So that's basically a theoretical paper, which was motivated by some application in financial markets. So the questions coming up in financial markets were slightly related to the previous talk, namely regime switches in Heston model, and then combination of regime switches and rough path or rough behavior of the price process. So this was a work which I started with Messias Alfors and Eric Stögel in Sydney. And we are continuing this to look at rough forward prices, which also have the common feature, and that's in the title that we consider inhomogeneous phenomena. So this motivated us then in Giessen to look at the existence and solutions of inhomogeneous affine Volterra processes and how we can describe those processes. So let me start with the motivation. Point of view, they have a kind of a regular behavior because they have all what's called quadratic variations. They are semi-martingales, and they are most of the time Markovian processes. But in several years, of course, these assumptions are questions from an empirical side. So here are some examples or motivation why you should look at more volatile processes than just Brownian motion. So underlying noises should have different features than Brownian motion. It is what's called rough features, which I will explain later. So in these pictures, you see, especially panel B shows you that the realized volatility in those financial markets, like the I think that just MSCI markets here, MSCI index, MSCI World Index, it's the implied, not the implied, the realized volatility, and their log returns look more like rough path than like Brownian motion. So put it simple, so their behavior is even more irregular than Brownian motion, meaning, for example, that the quadratic variation does not exist. So this makes many assumptions, this causes, of course, many problems in the modeling because most of our modeling approaches are based on martingale theory. Okay. So in the model, classical model for the volatility, or stochastic volatility, is a Heston model, and that's where we started with. So that's your asset price is more or less a geometric Brownian motion, where the volatility is stochastic. It's itself a stochastic process, which is here what's square root process, or sometimes called in interest rate a CIR model. which tells you that the volatility itself is a stochastic process where the volatility of volatility is proportional to volatility. That's why the diffusion term of the volatility is sigma times the square root of the volatility itself, and the drift term as a mean reversion effect. No? It's different, of course, from prices. Prices are more or less increasing, but volatility has a mean reversion effect. And so the two driving noises in this model from Heston in 1993 have a correlation R. Yeah, and we know from the stochastic processes that under the parameter constraint, that's 2 times the what's called kappa, the mean reversion speed, times theta, that's the mean reversion level, is larger than sigma square. That's the variance of volatility, let's put it like this. Then it doesn't hit 0. Yeah? Then it's a process which is not absorbed at 0. As I said, so the first papers with the feature that the volatility is rough are by Getherell in 2014. And there are many papers later on this. That's somehow as the first paper describing this phenomena. And so in the beginning, so they looked at the fractional Brownian motion. It's of course an old concept, going back to Mandelbrot. Let's see, the inventor of fractional analysis or whatever. So fractional, and so there's additional parameter. That's the Hurst parameter. That's why it's called H. Later we will reparameterize this one, but traditionally it was a Hurst parameter H. And you see if H equals 1/2, then fractional Brownian motion is Brownian motion. So the H gives you the H not equal to 1/2 gives you the deviation from Brownian motion behavior. Namely, for example, also the path properties depends on the parameter H. No? We know from Brownian motion, if H equals 1/2, then you have Hölder property of the path of the Brownian motion. Just let me see. Okay, if you're interested in this, there's now a lot of literature on the argument, which gives you argument that volatility is rough. Getherell by Euch-Rosenbaum. Euch-Rosenbaum, the papers in 2016, 2017 are also important for the further topics I will explain, because they also worked on rough Heston model, which we will explain on the next slide. So the rough Heston model, where the Brownian motion is replaced, the Brownian motion of the volatility process is replaced by a version of the fractional Brownian motion. As you see, that's also done in most of the work in financial markets on this, that you forget about the second part of the Mandelbrot fractional Brownian motion, namely the going back infinitely back in time. So you only go back in the kernel here, you only go back up to time 0. So the second term is let out, but basically the statistical path properties are more or less the same. And here you see the reparameterization. So alpha is the Hurst parameter plus 1/2. And you have this kernel, so the volatility. So here you have log Brownian motion, not with the volatility, which is a stochastic process. And this is now rough, if you like, Brownian motion with mean reversion, drift here the same, kappa is mean reversion speed, theta mean reversion level. That's the norming concept for this kernel. You see, and that's here you see immediately, so that's not Markovian, because at time t, you trace back until time 0, you trace back with this kernel what happens at the time before. The same is here, so that's what's called a kernel.
Excuse me, should
Yeah.
it be ds integration with respect to s variable here?
Yes, this is ds, of course. This is ds. Okay. Yeah. So that's ds. It's ds. So, but here you see that's what called a kernel. We also see some there. You might know that Volterra equation is also the equation which comes up in classical analysis without the diffusion part here. Yeah? But you see here from the path properties which you can get from these from this kernel, and that is not a semi-martingale, because semi-martingale have quadratic variation and jumps. Yeah? And let's see, and it's not Markovian because it keeps a memory from history. So this was the Euch-Rosenbaum framework to model volatility, rough volatility. Again, the new thing is a kernel here, and we will generalize this quite a lot in the theoretical part here. Okay, probably that's closely related to the previous talk by Ken. So that's, thank you for this, because that's the regime switches which we consider in our paper with Alfoys and Schlögel in 2019, I think it was published. And so here there are also empirical arguments why volatility has also regimes, no? With respect to Derman in 1999, and other papers showing the empirical evidence for this, and Elliott et al., which I don't know, Ken, whether you were in this et al., because we worked with Elliott on regimes.
This actually is the paper is in 2016 or 2000. What's the title of this paper?
I have to check.
Yeah.
So, but basically the approach is the same you explained. Yeah.
But
so
you know,
yeah.
Sorry. Yeah. Actually, I mean, there was one paper by Robert, Leung Chen, and myself, actually published in Applied Mathematical Finance. I think in 2006 or something. We are trying to 2006. We are trying to use, I mean, say, kind of a Heston regime switching stochastic volatility model to price volatility swaps. There was a paper in Applied Mathematical Finance, I think.
Probably that's the one, because that's of course on the Heston model, what Elliott and his co-authors did on the Heston model.
Yeah.
And so the only parameter which has a regime switch there was the mean reversion level, theta. There's only one parameter where you put regime switches on. And so basically this motivated us to combine the rough Heston model with the regime switch in the mean reversion parameter. Okay, that's how Ken explained it. So the regime switch is a Markov process with n different states coming with a transition matrix, and so that's a standard approach to the regime switches as we have seen previously. Yeah? For our purpose, so the challenge was that now you have let's say if each realization of the mean reversion function, a stochastic process describing the mean reversion of the regime switches, gives you an inhomogeneous parameter here. And so as you might see, because it's also already depend on time going back, that's not so easy to incorporate here a regime switch, inhomogeneous. You more or less need really quite a lot of new techniques, as we will see later. And at this time, when we started to do this in 2017, we started to do this. All these rough equations and the existence of this, as I have written here, was done on considering weak limits of Hawkes processes. That's kind of a special kind of self-exciting let's say, Poisson process or generalized Poisson process, where the jump rate depends on the previous jumps, like here. That's kind of self-exciting. So what happens before, and also here, what happens before, so how many jumps you already had will influence your jump rate. You accumulated jumps before. That's what's called Hawk's process, which are also used in some population modeling and so on. No? Those are continuous time. Hawk's process are continuous time, also a jump process. Okay. And so for this specific one, interestingly, where only the theta parameter is time dependent, this was already done in 2019 by Euch and Rosenbaum to show existence of stuff like this. They actually needed to provide hedging formulas in the framework here. Of course, these models are still complete as long as you only trade XT. Only if you start to trade, it's an incomplete market, then if you also start to trade volatility as well. So our approach so far is, financial point of view, so far is okay. The market itself is complete because the price is, what you trade is only X. Okay, then we started also in 2019 already to look at forward prices and wanted to incorporate rough volatility in the forward prices. Now, forward prices are by their very nature, they are time inhomogeneous. You always have a time, as you see, your forward volatility is usually inhomogeneous in time. So here, classical models, of course, assume here Brownian motion. So this kernel does not exist here. So alpha equals 1, put it like this. You have classical forward model with stochastic volatility of Heston type. And so we also work on this more empirically. But then we have, of course, questions, okay, does a model like this exist where now the parameters here are time inhomogeneous by their very nature. So both of these financial market observations or modeling approaches led to the question whether this type, so equation 6, what do we know about what then called Volterra equation, because it's a Volterra kernel. This comes already on this side from the classical integral equation theory and analysis, and so we add, of course, a stochastic term here. So if you just skip the stochastic term, that's a classical Volterra equation here. And it's time inhomogeneous. So this means it's not only the difference T minus S, an additional parameter of complexity, that the kernel depends on T and S separately, not only on the difference. But from an applied point of view, of course, we take here the rough kernel, which is 1 over T minus S to the power. But the parameters, so in the regime switching rough Heston model, the drift parameter was time dependent, so the S appeared here. And in the forward future prices model, of course, the volatility parameter was time dependent. So that's a very general type of equations, and KTS is a kernel. We come to more detailed definition later. Okay, what we consider here is an affine structure. Affine structure of a, let's go back if you have the diffusion case, k equals 1 all the time. So your drift term has this affine function of the state, and the S, the sigma squared, so the variance, put it like this. The variance function is also an affine structure in the stochastic processes. The underlying prices. And so if you have the case, you have two-dimensional Brownian motion, two stochastic processes, namely the price and the volatility, or the log price and the volatility. And so the kernel is the price or the log price has no rough features, but the no really kernel, and the volatility has this rough kernel. So that's a special case which motivated us to look this in general, more abstract setting, stochastic equation like this. So that's now the work with my colleagues here in Giessen. So what we proved, that if a solution exists, we have moment bounds for the solution, and that's in all this affine structure theory, affine processes, it's very handy, very useful that you still find a nice formula for the conditional Fourier Laplace function. Of course, from a mathematical point of view, this defines you the transition probability more or less. It's not a process, but it's actually not a Markov process, but still it's useful to know this type of Fourier Laplace functional of the conditional ones. And again, this is an exponential function, which is again to some extent affine in the path itself. So that's kind of in general, in so far in diffusion theory, you always have this, the conditional Fourier Laplace functional itself is an affine, the log of this is an affine function of the state yt. Of the state, sorry, xt, sorry, here you have it's a more or less an affine function of the entire path, which we will see later. But basically a formula like this, that's the main challenge, is the first important goal. I remind you, you have a process which is not Markovian, not a semi-Martingale. The only which is left from, let's say, classical stochastic analysis is this conditional Fourier Laplace transform, which you can still calculate or express in terms of this one. And you know, if you go back to application, this gives you an opportunity to price at least call options or simple options by like Fourier inversion formula and so on. So also from an applied point of view, it's useful. And that's what we have done for the regime switching graph Heston already, that also pricing formulas are based on equations like this. Okay, so this is a very general result, but of course there were many other results before. Let's remind you, remind you the affine processes. So we go back to Feller in 51, Kawazu, Watanabe. It's already classification of what's called branching processes with immigration at this time. Cox-Singer-Ross puts this into financial mathematics. And so in the beginning of this century, there was in the unifying abstract framework for the analysis of affine diffusions. And here you see you have a definition of affine diffusion. So you have a subspace of RD with some properties, with some general properties. And you have a drift function and a volatility function, put it like this. And you assume that the solution, a weak solution of the stochastic differential equation with drift function B and volatility function sigma exist. And then we call it affine, in this case by definition, if the log transform, the log of the, sorry, the log of the conditional Fourier transform is affine in the current state. Affine, take the log of this, it's an affine function. And this was done by Filipovic, I think, was the main, by Duffy, Filipovic, and Schattermeyer. This is the most important paper on this. They then could say, okay, if a process, if a solution of this type of stochastic differential equation has this form, has this property, then we know a lot about the coefficients B and sigma. Namely, that's more or less equivalent to the fact that the drift B must be affine in the state and the square of the volatility matrix as well. So if the Laplace function, the log of the characteristic function is affine, then also drift and S sigma square must be affine. And you can relate these, let's say, this coefficient in the affine function of the characteristic function with the parameters of drift and volatility in the following sense. So the phi and the psi appearing in the log Laplace function solve what's called the Riccati equation. And the Riccati equation, it's an ordinary differential equation in the time parameter t. And here's the coefficient of the variance function, put it like this, and the drift function appear. So that's a very nice result. So the affine structure of the log Laplace log characteristic function is equivalent. Yeah, you see conversely. Okay, you need then the solution, the solution of the, what's called the Riccati equation, and then you construct an affine. Then x is an affine process, and the log Laplace function will hold. Okay, and these models, affine processes, and this was also the motivation of Duffy, Filipic, and Schachamaya, because they unified this approach for like affine term structure models. That's where they come from, more or less. And the Heston models are both examples of those affine diffusions. And in this case, the Riccati equation can be solved in closed form, and then we know the log Laplace function of the Heston model is also known. And so that's, as I said, the log Laplace function. One gets this already done by Heston already, that you get these Fourier inversion formulas to get a kind of semi-explicit representation of chord prices. Okay. As I said, so this is about inhomogeneous affine Volterra processes. Of course, it was good that there was already some a lot of results on homogeneous affine Volterra process, but they were also quite recent. These are more or less in the group with Euch and Rosenbaum, other people working on this. They actually didn't work on the Hawkes process approximation of solutions to this equation. They had also kind of a more analytic approach. They looked at classical Volterra equations and extend this to stochastic Volterra equations. It's a paper by Abijaba, Polito, and Larsen in 2019. They considered the homogeneous version of our equation. Here, of course, T minus S, so that's a homogeneity in the kernel, and the B and the sigma do not depend on S. However, what they have done, used, which was not available for our analysis, that, as I said, so that's the resolvents of first and second kind. This comes from deterministic Volterra equations for the kernel K. But which was also useful for us, so stochastic integration with respect to non-semi-martingales is not needed. You might know that for this fractional Brownian motion, there is an entire integration theory where you can also integrate with non-semi-martingales. This might be another approach to this type of process, but that's not really followed in the literature. Okay, now here you see now the equation again we are considering with some more technical details we are considering here. The kernel should be bounded in this sense. And also you have the typical growth condition on B and sigma, which you already, of course, need in most of the standard stochastic analysis. And if this is satisfied, and if you have the solution, then we have this moment bounds that the for all p larger than 1, so the the pth moment of xt is uniformly bounded in time up to a finite time, capital T. And here, if you look at the proof of this lemma, here you need the converse inequality. You always need for estimations like this. And here, the Volterra integral equation, which you find in a monography by Grüttenberg et al., where classical Volterra equations are considered. Okay, affine structure is the same, but the drift function, the parameters depend also on S. No? I mean, in the diffusion case, actually, the results by Duffy, Filipovic, and Schachermayer on the equivalence of affine log Laplace functional and affine coefficients was also already extended to the inhomogeneous case. But basically, they considered the space-time process, which we also sometimes very useful for us to consider it a space-time process. Okay, so here that's what was known for affine diffusions. I just but in our case, of course, this does not mean especially that the Laplace functional is giving the every information up to time t depends only on the value of the stochastic process at time t. We cannot expect that this holds also for our non-Markovian process. But if you approach a diffusion or this equation from another point of view, you really see, if you apply Ito's formula to take the psi, so that's the solution of the Riccati equation, and let's say the non-homogeneous, the psi is a solution of Riccati equation, and you do Ito's product formula, you see that you can rewrite this, because you just have to say, okay, this is actually an exponential martingale, because this is a martingale with quadratic variation, like this one. So let's say from classical stochastic analysis, you see also that this equation holds in the diffusion case. And this looks like as if you can extend this to the rough case, or let's say the general Volterra case, but nothing to do with this non-Markovian structure. This is, of course, non-Markovian. Of course, at the end, in the diffusion case, it's the same as this. But here you see this might here depend on the whole history as well, ft. And so that's the basic idea, to extend this formula, which is, of course, not useful in the Markovian case because you know more precise formula. But this formula you can extend to the inhomogeneous, to the Volterra case and to the inhomogeneous one. Okay, you have new type of Riccati equations, namely that our psi solves now this equation where the kernel k appears. So this is actually formally the same equation if k equals 1. That's actually identity, k equals 1 for all, t for all, and k is constant equals 1. That's actually the Riccati equation. Also in the paper by, in the general structure paper by Duffy, Filipovic, and Schachermayer. So here we add, of course, a Volterra kernel. No? And then we could prove so this process, which appears also, okay, F was not, F is like this. That's important in this case that we consider still F because it's a non-Markovian process. We come back to this again. So, but this, which appears in the second version of the characteristic function, this process here, which you see, which you can, let's see, more or less straightforward calculate in the diffusion case, that this process, the exponent in the log Laplace function, in the Laplace function, or let's say log Laplace functional, satisfies also this classical stochastic differential equation. So it's yt. So yt is more or less log of the characteristic function. You see it's here a martingale minus its quadratic variation. Okay, so the theorem is, which also comes from the homogeneous case, is formulated in this way, so that this process yt equals this martingale minus its quadratic variation and the starting value. Also, it's of course can also be calculated. Here you have your fs again. Also this is, and then you could prove if this is a local martingale. You know, this is a local martingale. It's quadratic variation. In order to get the exponential martingale, you need to know if it's a true martingale. Then you get the formula for the characteristic function. And you see, because it's not Markovian to some extent, it's important that you have the Laplace function of the currents of the time t and the entire past. So this goes from 0t to fs, but you condition on ft, and then you are left with somebody which depends on the entire history from time 0 to time small t. So this is the main result. And so, as I said, this was proven in our joint project here with Julia Ackermann and Thomas Kruse. And so we need to develop some new techniques which were not covered by the classical analysis, because classical analysis like Rippenberg also considered only time independent or homogeneous kernels and also homogeneous parameters. I don't okay. So let's look at if this is the assumption that we can calculate the log Laplace functional VC, and that's what we later need for auction pricing if we want to apply it there, that we have an explicit formula for the log Laplace functional in terms of the solution of the Riccati equations. And in this case, everything here is deterministic because you have only x0 here. Because you can explicitly calculate. You know the solution of psi of the Riccati equations, and you just need to know x0. There's no, let's say, history before time 0. And you see the characteristic function is again exponential affine in x0. So the theoretically interesting question is when this Laplace functional given ft is exponential affine in the past path. When we would have an object which we would consider as infinite dimensional affine processes, and we might be back in the usual approach of affine processes, but in a complex state space. Okay, so far we have just assumed that exists a unique Milnor solution of the Riccati equation. So this will be analyzed in the examples we were considering. So first, solution of the Volterra equation itself. We could so far only prove that if again the kernel itself was time inhomogeneous. Time homogeneous, sorry, but that's also what we need for so far for application in finance, because our rough kernel depends, of course, on the difference between t and s. And so we could prove existence of the solution of the affine Volterra equation, or there we don't need that the coefficients are affine, so this is for general coefficients under the assumptions we had posed before, and some additional like Lipschitz conditions and so on will show you that this equation has a unique continuous strong solution. No? As in standard stochastic analysis, we need some Lipschitz conditions and so on. No? And actually, we didn't succeed to consider with very heavy assumptions. We could also take k, t, comma s. So we more or less restore to the homogeneous kernel, no? Which was also done by Avi, Java, Pulit, and Larsen. No? And then look at the space-time process. And here you see so the resolvents. No, I don't know whether my time is running out. Here, yeah, then if you have the homogeneous case like k bar k, yeah, then the advantage of working with kernels like this is depends only on the difference of the two time points. Then you have an entire literature and even books on the resolvents of first kind of this. That you have a kernel which gives you identity, so it's something like k bar to the -1. Yeah, so you get the identity back. Yeah, and this only works if you have a homogeneous kernel. And then you can also get much more results on the stochastic analysis of this if you can also apply this, because you can also apply kernels. Yeah? You can convolute, you have all this convolution, and the results on convolution from classical analysis to extend to prove existence. So let me see. I still want to tell you in my last minute. Yeah, so with this kernel, you can already ask this, answer these questions. Yeah, that the process, that the characteristic function. Yeah, this stochastic process yt has a special form involving the resolvents. Yeah, where you can see that yt is actually affine in the path. You see that's or is this convolution here, that's anyway, it's affine in the time point xt, but also in the path. Also you need, in addition, you need have an affine function of the entire path before time small t. Yeah, that's, for example, this one. You convolute xt minus s with this kernel where the resolvent appears. And of course, here you also see that this is also an affine function of the history of the past path of x. So under these assumptions, which you can check if you are interested in the technical assumptions, we could also prove that actually what we have here is an affine process, more or less viewed as a path process. Or condition characteristic function is path exponential affine. And here I skip this because these are especially in the special examples we were considering, like the inhomogeneous Volterra Hessian models. We also, of course, have to prove that all our assumptions are fulfilled, so everything go through, that there is a solution to the inhomogeneous Volterra Hessian model, yeah, like this one, exist, where here's one kappa. We can skip this kappa. So this is it's inhomogeneous affine, the inhomogeneous Volterra-Heston model, and everything is fulfilled which we have needed for our general theory. So our final goal to apply this to inhomogeneous Volterra-Heston model, the existence is proved in a much more general setting. So thank you very much, and I'm happy to take questions if I have found you again. Okay.
Thank you very much. Okay, from the audience, is there any question?
Yeah, may I ask one question?
Yes.
Yes. So I just wondered that in your model actually it involve the rough Heston process for the stochastic volatility. I just wonder. I mean, so let's say if the in a real situation, if we actually of course we don't talk about, there are some index for the volatility like the VIX VAX. If we don't consider that direction, let's say we consider the situation that the volatility is unobserved or hidden, then there may be a kind of filtering problem. Let's say there may be a kind of filtering problem for the rough Heston volatility. Have you considered the situation like if you say observe the share price and then filter the hidden process which is modeled by the Heston the rough Heston model?
Yeah, so this was considered in the previous papers where they argue that you need a rough stochastic volatility.
Yeah.
Of course, they proposed also other models. They don't only take the square root, also like one plus beta and estimate whether beta 1 minus beta, whether beta should be -1/2. In this, we haven't done this. We have actually done no. Even in the more applied paper, we didn't do really empirical work.
I see.
We just took this for granted that if there's enough people believing that's rough, so we can do some more structural questions on this.
Yeah, but of course, your model is very interesting, and also, it's a very interesting that you consider the approach where you use the stochastic integration without using the stochastic integration with respect to non-semi-martingale, and that actually make the thing simpler for the practical implementation.
So actually, what we do in this rough forward model, what's still a project so far, because we have many problems with the data actually. So, but here we really want to figure out which are proper first. How that's what typically you do in this forward model. How many factors you need, and whether they should be rough, or whether it's better, whether it's enough to just consider Brownian motions there. And so there we have actually this filtering problem, because already the number of factors and the parameters of the underlying volatility process, that's already done by filtering. But this might be a problem because filtering is, to some extent, of course, relatively easy if you have diffusion processes and stuff like this. But again, we want to filter out something from a non-semi-martingale, non-Macquarian process, so it's
very difficult, actually. Yeah, but thank you very much. It's very interesting talk and very interesting model. Yeah.
Thank you. Okay. Yes. So are you actually in Sydney now?
Oh yes, I'm in Sydney now. Now it's 1:30 a.m.
That's what I'm wondering.
I think it's a 5.5 hour ahead ahead of Indian time. Am I correct?
Yeah. Yes. Thank you very much for being with us late night.
Yeah. Actually, I enjoy very much. The talk, and the function today, tonight. Yeah, thank you very much. Yeah.
Okay. Are there any some other questions from audience? Okay. Yeah.
No, I just want to, say, just,
Sure.
Yeah, so you don't have a kind of a bye-bye or applause
not
button.
bye-bye. Actually, I want to say, I want to say thank you, but I clicked a wrong button. I think sorry for that. Yeah.
No, as it's the only one. There is no other. I didn't find another one because I was looking after your talk also whether I have kind of a clapping or applause.
Yeah, I
or
want to
something
clap
like
it.
this,
Yeah,
but it doesn't exist.
Yeah, there's no such function.
No. So Google Meeting is quite basic.
I still need to learn about how to use it properly.
Okay.
Okay, thank you very much to both the speakers
Thank
and
you,
the audience.
Thank you all also very much for your late work. Even it's almost weekend and you are still listening to talk. So it's really, thank you very much for this.